So we're going to talk about two different costing methods. And these two costing methods are used for very different reasons. We are required by US GAAP for external financial reporting purposes to use absorption costing. So everything that you've learned to date in this class, in the previous class in financial accounting, you learned absorption costing. We're just labeling this new term and then identifying what costs are included as a product cost or a period cost. For variable costing, this is a method that is available to managers for internal decision-making purposes. So we cannot use variable costing for external financial reporting. Not all companies use variable costing for internal decision-making purposes, but there is a benefit to using variable costing internally. For a lot of publicly traded companies, they're unlikely to use variable costing because they would have to report some of it. And they may not want to report this information to the public and potentially their competitors if their competitors are reading their financials. For variable costing is only identifying product costs as those product costs that vary with units of production. So those product costs that are going to increase as we produce more. So variable product costs are direct materials, direct labor, and variable manufacturing overhead. So only 3 product costs for variable costing. For variable costing, fixed manufacturing overhead, and then variable selling and fixed selling and administrative costs are all considered period costs. So product costs, why do we care about the difference between a product cost and a period cost?
It's because it's when they're expensed.
So it depends on how they're expensed. So product costs are attached to units of product, right? And considered inventory until sold. Upon sale is when we're going to expense these items. And this is the same under absorption costing or variable costing. Product costs are attached to units of product. They're sitting in inventory until these units are sold. Upon sale, they get expensed as cost of goods sold. Period costs, on the other hand, are expensed as incurred. So if I incur this cost in this month, I'm expensing it this month. I don't care if it's attached to a unit of product because it doesn't attach to a unit of product. It has nothing to do with production. For variable costing, they only consider 3 costs as product costs: direct materials, direct labor, and variable overhead. Fixed manufacturing overhead, even though it's a part of the production process and a cost that's related to production, under variable costing, it's not considered a product cost. So this is a big reason why we can't use variable costing for external financial reporting purposes. Because under external reporting purposes, we need all of our product costs. So absorption costing shows all product costs as product costs, cost of goods sold, direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead are all considered product costs under absorption costing. They all have to do with production. They're all gathered together, attached to units of product, inventoried until sold. Upon sale, they become cost of goods sold. Under absorption costing, there are only two costs that are associated as period costs and expensed as incurred: variable and fixed selling and admin costs. So our normal operating expenses that we're used to. The key difference between the two methods is the treatment of fixed manufacturing overhead. It's a product cost under absorption costing, and it's a period cost under variable costing. This understanding these two methods is extremely important, especially if you ever consider investing in a manufacturing company, because what you're looking at in the income statement could easily have been manipulated and completely legally manipulated under the US GAAP rules. So it's important to understand what to look for and to understand the difference between a variable costing and absorption costing. We're going to look at an example. Harvey Company produces a single product with the following information available. So they produce 25,000 units annually. They have variable costs per unit, direct materials, direct labor, and variable manufacturing overhead totaling $10. You normally are given direct materials, direct labor, and variable overhead separately as a cost, but this one we're just lumping it together as one. And they have selling and administrative expenses that are variable, $3 per unit. They have two types of fixed costs: fixed manufacturing overhead, and then selling and administrative expenses that are fixed. We're going to calculate the unit cost for each of these methods under absorption costing and then variable costing separately. So we're going to do absorption first. Under absorption costing, you have 4 costs. What are my 4 product costs under absorption costing?
Direct materials,
Direct labor.
variable manufacturing overhead, fixed manufacturing overhead.
So direct materials, direct labor, variable manufacturing overhead, and then fixed manufacturing overhead. So for the first 3, they gave it to us as $1 amount. So I'm just going to include it here. $10. And for fixed manufacturing overhead, what do we know about fixed costs?
They
We're gonna have to pay it regardless.
We have to pay it regardless. So they give us an annual amount or they give us a monthly amount. It's a set total amount that they have to pay regardless of units of output. We also know that fixed manufacturing overhead on a per unit basis has an inverse relationship with activity. So as activity increases, fixed manufacturing overhead or fixed costs in general will decrease on a per unit basis. For fixed manufacturing overhead, we have to put it on a per unit basis. So we're going to take our total fixed manufacturing overhead, and we're going to divide this by, and this is the key part, and you want to highlight it, the number of units produced. It's the only time that you're going to use this quantity. So fixed manufacturing overhead per unit depends on quantity produced. For this company, they have $150,000 in fixed manufacturing overhead annually. And they have annual production of 25,000 units. So 150,000 divided by 25,000 units produced, and write that units produced portion. Gives us a fixed manufacturing overhead cost of how much per unit?
$6.
$6 per unit. So cost of goods sold for absorption costing this year is $16 per unit.
Where do you get the $16 from per unit?
It's the sum of direct materials, direct labor, variable manufacturing overhead, and then fixed manufacturing overhead.
That makes sense.
No worries. It's Monday. Okay. For variable costing, we include 3 numbers. Direct materials, because as we produce more, we're going to incur more direct material cost. Direct labor, as we produce more, we're going to incur more direct labor cost. Variable overhead, as we produce more, we're going to incur more variable overhead cost. Only the variable costs of production are included under variable costing as product costs. So variable cost of goods sold is $10 per unit this year. Expect on the test to have a question that's having you calculate the unit product cost. And then for every problem that you have to do an income statement for absorption costing and variable costing, you're going to have to do a unit product cost for each year that you produce units. If production changes during a year, you're going to have a different dollar amount for cost of goods sold for those units that you produce. So you have to calculate your unit product cost for each year that you produce units and for each income statement you're preparing. Does this calculation make sense? Is it pretty difficult to do?
No, it makes sense. Just I thought we were gonna have to divide the 25,000 into the 100,000. Like, are we gonna get to that later?
So only for the only fixed costs that you're dividing the units by, it's only fixed overhead. For any other fixed costs, fixed selling and admin costs, you're never going to divide it and calculate on a per unit basis.
Okay, makes sense.
Yeah. Okay. Now we're going to get into the income statements. So when we're talking about absorption costing and variable costing, absorption costing is used for external financial reporting purposes, and we use a traditional income statement. So sales minus cost of goods sold gives us gross profit, less our operating expenses gives us operating income. Separating our costs, product from period costs. based on function. Variable costing uses the contribution income statement, which you have never seen before. The contribution income statement looks at costs differently. We're separating costs not by product and period costs, but we're separating costs by variable versus fixed costs. For the contribution income statement, it's easier to use for things like projections or estimates, calculating the break-even point, calculating an estimated earnings that we could potentially have if we change some things around. So we're going to use the contribution income statement in the next chapter and in later chapters when we're kind of saying, if we try this, then this might happen. The traditional income statement, what we're using for external financial reporting, we have to use this for GAAP, but it's not good. It's not convenient for managers to use to kind of manipulate numbers and to look at different situations. So there's a purpose for both. And what you're going to see is that they don't necessarily come up with the same operating income, even though we're including similar information. So we're going to look at year one. Let's assume the following additional information for Harvey Company. 20,000 units were sold during the year at a price of $30 each. There is no beginning inventory. So we're going to use and look at inventory in units because it's going to help us later on. So our beginning balance in inventory is 0 units. And their annual production is 25,000 units. So it increases inventory by 25,000 units. And in year one, they sold 20,000 units. So in inventory at the end of year one, 0 plus 25 minus 20, they're left with 5,000 units at the end of year one that they haven't sold. So I'm just going to include some setup information. $25,000 were produced and 20,000 units were sold in year one. Sorry. So we're going to start with absorption costing. And with the traditional statement, which you should be used to creating, What is the first line item of the income statement?
Sales revenue.
Sales revenue. Okay, so sales revenue is always at the top. And I'll use green to show you calculation. How do I figure out sales revenue?
Take the units sold by the price.
So number of units sold, which is 20,000 units sold, times the selling price per unit, which is $30 per unit. So the income statement is always number of units sold. And year one, what was sales revenue?
600,000.
600,000. With the traditional income statement, we're separating product costs from period costs, and we always display our product costs first. So now we're going to subtract cost of goods sold. Our product costs. And how many units are we going to expense as cost of goods sold?
20,000.
20,000, the number of units sold. So 20,000 units were sold. And what is our cost of goods sold per unit?
$13.
Thought it was $16.
16. I wrote it down here again, sorry. So remember we had 10 for direct materials, direct labor, variable overhead, plus $6 that we calculated for fixed overhead, so $16 per unit.
What about the selling and administrative expenses?
So for the variable selling and administrative expenses, that's considered a period cost, and it'll be down below when we subtract out operating expenses.
Okay.
But good question. So product costs and what's included in cost of goods sold are only those four numbers: direct material, direct labor, variable overhead, and fixed overhead on a per unit basis. For cost of goods sold, how much did you calculate in year one?
320,000.
320,000. Sales revenue minus cost of goods sold gives us what subtotal?
Gross profit.
Gross profit or gross margin, either are acceptable. So 600 minus the 320, right, gives us gross profit, or the excess of sales after subtracting product costs, of 280,000 in year one. The last step is subtracting out our selling and admin expenses or our operating expenses. So we're going to list them out separately because they gave it to us separately. And we can start with variable selling and admin. And we're going to have to do another calculation. How many units do we use?
30.
So you have two options, 25,000 units or 20,000.
Got the wrong number.
I know which year you're looking at. It's 20,000 units sold. Because we're only incurring costs as they sell units for variable selling and admin at $3 per unit. So I'll use the inner column over here. $60,000 in variable selling and admin. The last period cost that we have is fixed selling and admin expense. And we expense as incurred for period costs, and we incurred $100,000 in costs. So we're going to expense the entire amount. These are our period costs right here. $60,000 in variable selling and admin plus $100,000 in fixed selling and admin gives us a total of $160,000 in operating expenses. $280,000 in gross profit minus $160,000 in operating expenses gives us operating income
120,000.
of $120,000. Is the traditional income statement coming back to you a little bit?
Very much so.
Okay, good. So separating product costs based on function, separating expenses based on function, product costs separated from period costs. For the contribution income statement, it's still an income statement. It's just that we have some different subtotals and numbers are included separately or differently, somewhat. So with the contribution income statement for variable costing, we're still going to start with sales revenue. Since we already calculated it before, we know that they sold 20,000 units sold at $30 per unit. I don't have to show the calculation again, but I'll do it just so that you can see it for this first year. So in the variable income statement, we're going to show $600,000 in sales revenue, the exact same amount that we show for absorption costing. After sales revenue, we then separate and subtract out.
Aren't you in class?
We separate out variable expenses. The first variable expense we're going to include is variable cost of goods sold. Okay. So the product costs that we calculated for variable costing. 20,000 units were sold. So that's what we're expensing. And variable cost of goods sold, variable product costs include direct material, direct labor, and the variable manufacturing overhead only. Only those product costs that vary with units of production. So $10 per unit. So in year one, how much was expensed as variable cost of goods sold?
200,000.
$200,000. Do we have any other variable expenses?
No.
So up here, we took care of the 10. And then they also have variable selling and admin expense. So we need to take care of those 3 per unit. So since these are variable costs, we're expensing them up above. So 20,000 units sold times $3 per unit. It's the same exact calculation that we did for absorption costing. It's just that we're including it up with variable costs and expensing $60,000 here. I don't care that this is a product cost versus a period cost. In the contribution income statement, I'm separating costs based on cost behavior. Variable costs separated from fixed costs. So we have $260,000 in variable costs that we're going to subtract from sales revenue to calculate the contribution margin.
I have a really fast question.
Yes.
Why is it that we don't use the fixed selling and administration in the variable?
We will. We're not
Oh,
there
we
yet.
will. Okay, I was gonna say I didn't see us use it as a operating expense or variable expense.
We're not there yet because it's a fixed cost.
Gotcha.
So the contribution margin is the excess of sales after subtracting variable expenses. So the excess of sales after subtracting variable expenses is our contribution margin. For this particular case, 600,000 minus 260,000. How much is our contribution margin?
340,000.
$340,000. After we calculate the contribution margin, now we subtract all of our fixed costs. Fixed costs are treated like period costs. All fixed costs are expensed as incurred under variable costing. So when you get to the fixed cost portion of the variable income statement, know that you're not going to do any calculations. You're going to take the number that they give you and include it down below. So we're going to start with fixed manufacturing overhead. And we're going to expense $150,000 because that's the amount that's incurred in year one for fixed manufacturing overhead. Expensed is incurred because it's considered a period cost under variable costing. We're going to do the same with fixed selling and admin. 100,000 is expensed as incurred. So 150 plus 100 gives us 250,000 in fixed costs. When we subtract 250 from the contribution margin of 340, what do we come up with as operating income?
90,000.
90,000. Same year, same units produced, same units sold, but I'm showing $120,000 in operating income under absorption costing and only $90,000 under variable costing. Did I make a mistake? Is there a way to know if I made a mistake?
Plug something back into something else.
There is a way of double checking your work. There is no mistake. These two methods do show a different income depending on different scenarios that happen.
Why would a company one versus the other?
So we are required to use absorption costing for external financial reporting purposes. We have to use it. A company has the option to use variable costing for internal decision-making purposes. So if a company is creating a variable income statement, they're also at the same time preparing an absorption income statement because they have to for financial reporting purposes. This is an optional method.
But they just want, if they use variable, it makes their income lower. Their
In
expenses.
this particular year, it's not always the case.
Oh, okay.
For do a little calculation off to the side. What's the key difference between the two methods? Do
The
they-
absorption, you divide the manufacturing overhead by the number of units produced.
Yeah. So manufacturing overhead that's fixed manufacturing overhead is put on a per unit basis under absorption costing. So under absorption costing, a portion of fixed manufacturing overhead is included as inventory. It's not expense in that current period in this first year. Under variable costing, it's considered a period cost, and the entire $150,000 is expensed in the current year. You expense it as it's incurred, just like other period costs. All the other costs are expensed the same. The same amount of revenue is earned. Direct materials, direct labor, and variable overhead, $10 per unit for each. That's the same. Variable selling and admin expense, $60,000, $60,000, it's the same. Fixed selling and admin of $100,000, it's the same. The key difference is the treatment of fixed manufacturing overhead. So when we're trying to see if we have it correct, you can start with your variable operating income. So variable costing operating income was $90,000 in year one. And I'm going to add back fixed manufacturing overhead, deferred, and inventory. So basically, fixed manufacturing overhead that's included in inventory. So it's sitting as an asset and not expensed in the current year. So we have 5,000 units in inventory that we didn't sell, right? We produced 25,000 units. We sold 20,000. Inventory increased and we have a balance of 5,000 units. And we're going to multiply that times $6 per unit, which is our fixed manufacturing overhead per unit. the portion of fixed manufacturing overhead on a per unit basis. And when I take 5,000 units in inventory times that $6 per unit, that gives me the total amount of fixed overhead that's sitting as an asset that wasn't expensed under absorption costing this year. I incurred the expense, but I didn't expense it because it's a product cost. So 90,000 plus 30,000 gives me 120,000. Which is my absorption operating income this year. The difference between the two operating incomes is $30,000. Which is the amount of fixed overhead that was not expensed under absorption costing. If you look here, under variable costing, the entire amount was expensed. Versus only 120,000 of that 150 that was expensed under absorption costing. We're going to take a break here. Questions?
No, right now I'm just trying to process all the information right now.
I know. Process it within the 10 minutes. Come back by, let's say, 1:45.
I'm sure I'll have some questions after I work on the homework.
Yes, absolutely. And when we get to year 2, it'll make more sense. So we're going to continue on with Harvey Company and look at year 2. In year 2, the number of units produced was 25,000. Number of units sold in year 2 was 30,000. So in year 2, we started with 5,000 units in inventory, beginning inventory. We produced 25,000 and then sold 30,000. So what's the ending balance in units?
0.
0. So 0 units left over at the end of year 2. For the unit selling price, it's the same at $30. Variable costs, direct material, direct labor, variable manufacturing overhead are still $10 per unit. So we can include it down here. And these are the variable product costs for production in year 2. Selling and admin, the same. Manufacturing overhead is still the same. So fixed manufacturing overhead of 150,000 divided by 25,000 units produced is still going to equal $6 per unit. So the unit product cost for cost of goods sold for absorption is still going to be $16 per unit. And then variable cost of goods sold is still going to be $10 per unit for variable costing. The reason why I rewrote it again was because you may see in a different example production being different in 2 different years. And your unit product costs for those units that are produced in year 2, if you produced more, would be different under absorption costing because fixed manufacturing overhead depends on production in that current year. So the cost of goods sold per unit could be different for units produced in that second year than it is in year 1, potentially. For year 2, we produced 25,000 units and we sold a higher quantity, 30,000 units were sold. Do you want to try to compute the income statements yourself?
Sure.
Okay, I'll pause the recording. Okay, so for absorption income statement, sales revenue, how many units were sold in year 2?
30,000.
30,000 units were sold in year 2. And the selling price per unit is
$30.
$30 per unit. Correct. So how much did you calculate for sales revenue in year 2?
900,000.
9,000.
900,000. Perfect. For cost of goods sold under absorption costing, how many units were sold? How many units am I expensing as cost of goods sold?
30,000.
30,000.
30,000 again. At what unit product cost?
$16 a unit.
$16 per unit. So cost of goods sold in year 2 is higher because we sold more units, right?
Yes.
And how much is cost of goods sold in year 2?
480,000.
480,000. So you took sales revenue of 900,000 minus cost of goods sold of 480 to calculate gross profit of
420,000.
420, correct. And then we're going to subtract out our operating expenses. So variable selling and admin, you had to calculate again. How many units were sold?
30,000.
30,000 units were sold at what unit product cost? Or I'm sorry,
$3.
what unit cost? $3. So in year 2, variable selling and admin was 90,000. Fixed selling and admin is the same. It's still $100,000. So in year 2, we're subtracting 190,000 in operating expenses from gross profit of 420 to calculate operating income of how much?
230,000.
230. Questions on absorption, or do you feel pretty confident on that one?
That one's not so bad.
It's not too bad, except for if there's a little glitch, which I'll give you an example one for later. For variable costing, you don't have to do the calculation again. You know that it's 30,000 units that were sold, and the selling price was still $30 per unit. So you calculated 900,000 again in sales revenue. You're then subtracting out your variable expenses. Variable cost of goods sold, 30,000 units were sold. And what was my variable product cost per unit?
$10 per unit.
$10 per unit. So you calculated what as your variable cost of goods sold?
300,000.
$300,000 in year 2. You sold more units, you would expect a higher cost, right? Yes.
Yeah.
Yes.
Variable selling and admin, again, we already calculated it for absorption, so you could just carry that number over. 30,000 units sold times $3 per unit, so 90,000 is expense. And our total variable expenses were 390, correct?
Correct.
Yes.
And sales revenue minus my variable expenses gives me contribution margin of what in year 2?
510,000.
510,000. Fixed expenses, we have fixed overhead and then fixed selling and admin. How much was fixed overhead?
150,000.
150,000. How much was fixed selling and admin?
100,000.
100,000. So 250,000 in fixed costs, same exact amount as we had last year, correct?
Yes.
Because those on an annual basis didn't change. And the expense did all. What is my operating income under variable costing?
260,000.
260,000. So year 1, we showed a higher absorption income. Year 2, we're showing a higher what? Income under
Variable.
variable costing. It flipped. Let's see if we have it correct. Variable operating income is 260 in year 2. And in year 2, what happened to inventory? And did inventory increase or decrease in year 2?
Increase.
In year 1, it increased. It went from 0 to 5,000 units.
No, decreased.
Year 2, it went from 5,000 units to 0 units. So we had a reduction in inventory. So we're going to have less fixed overhead released from inventory. In year 2, the production, the units produced in year 2, the 25,000 units, were all produced and sold in the same year. So under both methods for the year 2 production, all of it was expensed. All the product costs were expensed in the same year. The only difference is those 5,000 units that were sitting left over from last year. Those units were now sold. So now we have an additional 5,000 units plus a fixed overhead that's expensed in the current year. Because under both methods, 30,000 units, direct material costs, direct labor costs, and variable overhead costs are expensed in year 2. In variable costing, only 25,000 units worth, if you will, of overhead is expensed in year 2. Fixed overhead, because fixed overhead is expensed as incurred. The entire amount is expensed as incurred. It doesn't attach to units of product. But for absorption costing, a portion of fixed overhead in year 1 was sitting as an asset. And now that those units are sold, they're getting expensed. So we have a reduction in inventory of 5,000 units times the fixed overhead that's expensed per unit, $6 per unit fixed overhead, is being released in the current year. So $30,000 is being subtracted to back into absorption's operating income. $230,000. variable costing is giving you the more true and accurate reflection of what earnings are. If you look at truly of costs that are incurred for the period versus revenue that's earned for the period. It's more reflective of reality. But for external financial reporting purposes, we are required to use absorption costing. Now, what happens if I decide to still have 150,000 in fixed overhead? That's how much my fixed overhead cost is. What happens if I want to produce 50,000 units? If you're producing more units, you're incurring a higher cost, right?
And then it changes your cost of goods sold, right?
Changes your cost of goods sold. It changes your unit product cost. Still $10 per unit for direct materials, direct labor, and variable overhead. But just changing production and increasing the number of units produced, what happens to fixed overhead per unit? 150 divided by 50,000. Now it's $3 per unit. So if I produce 50,000 more units, my unit product cost goes from $16 per unit to $13 per unit. But I only expense the units sold, so I only sold 25,000 in year one. I'm saving $3 per unit in cost of goods sold cost. What happens when your cost of goods sold decreases? Gross profit increases and your bottom line increases. A company can legally produce more units to reduce their unit product cost, to reduce cost of goods sold for the year and increase their bottom line. If I'm an investor and my sole thing that I'm looking at is net income and earnings per share, and they're achieving those marks that I think they should, but I neglect to look at the balance sheet where you would see the spike in inventory, they could completely make that company look better than it is. On a cash basis, though, think about it. When you produce more units, you're incurring more costs. You may never sell those units. But GAAP allows you to manipulate your earnings if you produce more units, and it's completely legal to do that. Is it a long-term gain that you're focusing on? No. It's not wise to do that. You're not going to maintain your business for very long. But there are industries that do that.
The shady game then.
But you got to be an aware investor and look at all the pieces of the pie. Don't just look at that one number. So is there a way to know what's going on? Yes. Is there a way to know if one's going to show a higher income than another? Yes, there is. So let me just get my little sheet so I write it correctly. When units produced equal units sold. So this is going to be for the 2-year period together. We produced 50,000 units and we sold 50,000 units in total. There will be no change in inventory. Right? Because we went from a beginning balance of 0 units to an ending balance of 0 units. And absorption, operating income will equal variable operating income. If you add up operating income from year 1 and year 2 for absorption as well as variable costing and compare them, they will equal. So as long as you sell all the units that were produced, eventually these two will show the same. When units produced are greater than the number of units sold.
Can you move the sheet down, Professor?
Yes. Sorry, I
you.
always forget that you can't see at the very bottom. So this would be year 1. In year 1, you produced 25,000 units. You only sold 20,000 units. You would have an increase in inventory, right? We went from 0 units in beginning inventory to 5,000 units in ending inventory. Absorption operating income will be higher than variable operating income. In year 2 is the last scenario when you produce, units produced is less than the number of units sold. You're going to see a decrease in inventory, right? We went from 5,000 units to 0 units. And in that case, absorption, operating income is less than variable operating income. Merchandising companies don't have this issue because they don't have fixed overhead. They don't have a fixed cost that we're spreading over units produced like we do with manufacturing. So this is specifically a manufacturing issue. The other place that you would want to look in the financial statements for a company, for a manufacturing company to see this is statement of cash flows, because you would see that change, that spike in inventory, and it would adjust income from that accrual basis to a cash basis operating income, and you would see it there as a stark difference. Now, questions on this? I know you're digesting. The calculations, are they pretty basic?
Yeah, it wasn't that difficult. Once you know where to look, it's pretty simple.
Good. Keep that in your mind. The problem that you're going to see in the homework questions is not going to be with variable costing. Variable costing, you're going to do just fine. The problems that you're going to see are going to be for absorption costing, specifically when you get to year 2. So this problem, I just had it set up because I did it last year. This particular problem has you looking at 2 different years of production. And they do change the number of units produced from year 1 to year 2. So I want you to get started on it, and then I want to go over it next class if we don't have time at the end of this class, because this problem is going to be very similar to your homework problem, and I want you to feel prepared for it. So I put in the unit product costs for absorption and variable costing for year 1 and year 2. Or sorry, year 1 first. So $50 per unit is what you should have calculated for the unit product costs for year 1 production of absorption. $45 per unit for variable costing. For absorption for year 2, you should have calculated 51.25 per unit. Did you have to do a second calculation for variable costing? No. This is for year 1 and year 2, right? Because product costs per unit are constant. If there was no change in the unit product cost, then it wouldn't change year over year for variable costing. But because production changed from year 1 to year 2, the unit product cost under year 2 is different than the unit product cost under year 1 production. So they produced 50,000 units at a cost of $50 per unit for year 1, and 40,000 units were produced at a product cost of $51.25 for year 2. In year 2, I asked you to create the income statements.
Oh, I've got one question about absorption costing. For year 1, the cost of goods sold is $50. If they sold 40,000 units, wouldn't we do the fixed overhead divided by 40,000, not 50,000?
No, so fixed overhead is always based on production, number of units produced.
Okay.
So it's always going to be that.
Okay. Thank you.
You're welcome. So for sales revenue, you took 50,000 units sold times a selling price of $60 per unit, and you calculated sales revenue of what amount?
3 million.
$3 million. For year 2, for cost of goods sold, you're going to have 2 calculations, because if you only used one calculation, it's wrong. So you have 10,000 units that are left over from year 1 production that have a unit product cost of $50 per unit. And then you have 40,000 units from year 2 production with a unit product cost of $51.25 per unit. Only in year 2 is this going to be the case, because you have those units hanging over from year 1 that had a different unit product cost than year 2. So year 1, you had $500,000 in cost of goods sold for those 10,000 units. And then year 2, it was an additional 2,050,000. So year 2, total cost of goods sold was $2,550,000. Now, what I've seen in the past and what you're getting wrong in your homework, if you get this part of the problem wrong in your homework, is that you're using and expensing either 50,000 units at $50 per unit or 50,000 units at $51.25. So if you're getting this number wrong and you're like, I know I'm getting the calculation right, I have the right number of units, it's likely that you're using the wrong unit product cost for some of them.
Question.
Yes.
Why don't we use that? Why didn't we use that for the problem before? Because there was still like 5,000 left over.
Because they produce the same number of units in year 1 and year 2.
Got it. Okay.
Yeah. So it was the same. In
Just changes
theory,
change the amount of
in
units.
theory, you could write it out separately in the last one, but it wasn't, there was no point in doing it.
Got it.
Yeah. So then you keep going through it. You come up with 450,000 in gross profit. And then honestly, I think the rest of the income statement, you're not going to have errors with. I just wanted to show you specifically that portion. And now I feel confident that you're not going to have any trouble with your homework, or if you have trouble with your homework, you can come back to this and you know what to look for. If you want to finish this one and send it to me, I'll give you extra credit. So if you want to do year 1 and year 2 and the income statements for both, I'll give you extra credit. But otherwise, I feel more confident sending you off to your homework now. And I don't need to waste your 5 minutes, okay? So, next class, we're going to start chapter 7. Chapter 7 pre-assignment will be due tomorrow night, so just make sure you don't forget that. Go back and do any homework that you may have forgotten, ran out of time for. Keep on track with it. I can't believe we're in week 7, but have a wonderful day.
When did we finish? I forgot. When?
December.
Because I thought, okay, some people who started, because we started like 2 weeks earlier than most schools, so I thought we might end earlier. But
We are a traditional 16-week college, so we will go all the way to week 16, and we don't have a break until Thanksgiving break at the end of November. So fall semester always like drags on. We're in week 7.
Gives us plenty of time to learn.
more
Yes.
than halfway.